Hello, I'm Richard Murphy, and I want to talk about an issue that I've been asked to discuss, and that is the difference between fiscal policy and monetary policy. And I've been asked by a friend to produce this video because they say they keep hearing these terms on the news, in the papers, and amongst politicians, and frankly are not sure what they really mean. So let me give you my nutshell explanation. All governments want to control the outcomes that happen within the economies for which they're responsible because they know that a strong economy with stable inflation produces situations where they get elected. There is a very basic motive for politicians to engage with the economy for which they're responsible. But they only really have two ways to do that, and these are described as monetary policy and fiscal policy. Let me describe them in turn, then let me compare them. Monetary policy basically tries to control the economy through one of two measures. One is interest rates, and the second one is quantitative easing. Interest rates is the one that most people associate with monetary policy. When the government wants to stimulate economic activity, when it uses monetary policy, it cuts the interest rate. It reduces the cost of borrowing. It therefore presumes that more people will borrow. More people who borrow mean that more people spend. More people who spend means there's economic growth. It really is as simple and straightforward as that. That is what monetary policy means. The difficulty with monetary policy for a government who wants to pursue it in the last decade is that interest rates have reached what have been called the zero bound. That is, they are near enough nothing. And when interest rates reach near enough nothing, unsurprisingly, changing them by very much still has very little impact because, well, for over a decade, official interest rates have been less than 1%, and that just simply does not produce this desired effect. Therefore, the alternative that has been produced has been quantitative easing. Quantitative easing is a monetary policy. It injects new money into the economy as a result of the government buying back its own bonds, literally using newly created money created by the Bank of England to buy bonds that have been previously issued by the government to finance its deficit. And by buying the bonds back, what the government does is two things. First of all, it forces up the price of the bonds and so forces down the interest rate. They actually have moved into net negative areas as a result. And again, by buying the bonds, it forces money into the economy, and forcing money into the economy increases the desire of people to spend, and the desire for people to spend is what they hope will increase economic activity, and in the current situation has actually been what they hope will increase inflation to 2%, which was their goal for their monetary policy over the last decade. It's a simple policy and it's almost entirely focused upon an inflation rate. And why is it focused on an inflation rate? Well, because governments believe that keeping money at a fixed rate of inflation is important because that stabilises the value of money for the benefit of the wealthy. The unemployed do not feature in monetary policy. They are an incidental cause of damage. If they so happen that their unemployment goes up as a consequence of interest rates going up, so what is the consequence within monetary policy thinking? In fiscal policy, the thinking is entirely different. Fiscal policy uses government revenue and government spending as the way to influence the behaviour of people in the economy. Now, the difference between government income, that is literally taxes and other sources of income, because there are sources beyond tax, fees, fines and other things also contribute. But the government income is compared with government expenditure, and the two, when considered one against the other, create a fiscal balance. Now, that fiscal balance can be positive or negative. In other words, the government can have more income than it has expenditure, or it can have less income than it has expenditure. When the government has more income than expenditure, in other words, it taxes more than it spends, it's effectively dragging money out of our pockets and putting it out of use. When it does that, it suppresses the level of economic activity in the economy because literally it's taking money out of circulation, it's taking demand out of the economy, and we therefore spend less. And therefore, if the economy is overheated and running out of control or there is inflation, that brings down the level of economic activity and brings, it is hoped, the economy back into balance. Do the reverse and the government spends more than it has got an income, the hope is that you will stimulate the economy and put more demand into it, create more jobs, increase economic activity, and so on. At the end of the day, the object of fiscal policy is to create a balance. The balance is around full employment. That is the object of fiscal policy. It is not the object of fiscal policy to create a stable inflationary environment, although that obviously would be useful, but instead it is to create full employment. So the focus of fiscal policy and monetary policy is quite different. One is focused upon inflation, the other is focused upon employment. But it's not just employment that fiscal policy looks at. Fiscal policy can also be used to promote particular activities and particular types of benefit for some groups in society over others. So fiscal policy can be used, for example, through particular tax policies or through particular types of expending to, for example, encourage investment. So it could be used to encourage the green economy. It can be used to provide support for heavy industry if that is what is desired by a government. It can be used to support technology and IT industries if that again is what the government wants. So by focusing both subsidies and taxes at particular activities, they can be encouraged. Again, fiscal policy can also be used to redistribute income and wealth within the economy because it is known, for example, that the wealthy save. It's not a great surprise. After all, they're wealthy precisely because they have saved. And therefore, if the government wants to increase the amount of spending in the economy, it might increase as tax on the wealthiest because that takes money away from them which they don't spend and which they would otherwise simply store in their savings accounts and redistributes it to those who have not got a sufficient income or who would like more income, and they will spend more of that income than the wealthy will as a proportion of what they get, and therefore will boost economic activity as well. So overall, fiscal policy has many more instruments to bring to bear in terms of producing an economic outcome than monetary policy has with its blunt instruments of just interest and quantitative easing. The two together, of course, can actually become a more powerful combination than using one or other in isolation. There is good reason to control inflation in an economy, although the risk of it is very low until full employment is reached. And there is good reason to target the level of spending at particular types of activity if a government, quite reasonably, wants to promote certain things to suit either certain interest groups in society who it thinks will vote for it, or more generally, thinks it is the right thing to do. In either case, a combination is the normal approach, and I would very strongly support the use of both. So, for example, at present, quantitative easing should be used to provide the funding to create the opportunity for investment in the green economy, which is fundamental in my opinion, and if that can't be raised in the money markets, then QE can substitute for the absence of money market willingness to buy bonds by effectively providing the finance to government to do this investment instead. So the combination is at least as important as either of them. Traditionally, monetary policy has been seen as the territory of the political right wing because of its focus on preserving wealth. Fiscal policy has been seen as the territory of the political left wing because of its focus upon encouraging government-led activity in the economy and focus upon full employment. Actually, the two have to work together, but it's necessary to understand that they provide a range of tools which lets the government intervene to produce well-being, and that has to be the focus and the outcome. But one thing that neither, in my opinion, says is necessary, and I stress this very strongly, is that the government has to balance its books. The government has to balance its economy. Monetary policy tries to balance its economy around an inflation rate. Fiscal policy tries to balance the economy around an unemployment rate, or rather around full employment, in my hope. I believe that balancing around full employment with sustainability is the vital goal and should be the object for the future, and therefore fiscal policy has a higher priority than monetary policy, but one without the other makes little sense. We need to use the tools we have available sensibly and wisely to achieve the best for society, and that is balancing our economy around a goal upon which we can all agree, and surely that's full employment, so that the books balance themselves because people literally are all at work at fair pay if that's what they want, and around sustainability, because for the long-term well-being of our society, that is essential. Fiscal and monetary policy could let us do that, but only if motivated or used by people motivated appropriately. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk, and we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.